I'm Sebastian St. James. If you buy an S&P 500 ETF, you could be wasting your money. Today I will tell you why you should potentially avoid the S&P 500 altogether. In my previous video, the Ultimate ETF, we compared the Nasdaq-100 with the S&P 500. We found some impressive things about the Nasdaq-100, but the question is, should the S&P 500 still be the core of your portfolio from an ETF point of view and you just have a bit of Nasdaq-100 on the side, or should you replace entirely the S&P 500 with the Nasdaq? That's a good question. First of all, we have to look at traditional advice. Buy a broad-based index fund. So, an index fund. Is the S&P 500 an index fund? No, it's an index, but you can buy an index fund based on that index. Also the Nasdaq-100, yep, that's an index for sure. So far they both pass the index test, but what about the broadness? The S&P 500 is somewhat broad. Now, it's not the total market, but yeah, broad it more or less is. What about the Nasdaq-100? 100 stocks versus the S&P 500. Clearly, it's not that broad, but let's compare it with other index funds. Here is a whole lot of random letters shoved together. It is the ETPMPD. Yes, it is an ETF which tracks the price of physical palladium. Palladium is a metal, and this tracks the actual price of it as if you're really holding the actual physical thing. Is it an index fund? Well, yes, it tracks an index from the point of view it's the price of the palladium, and there's no human decision involved. It's literally just following the index, the price, what's going on. So yeah, I'd call that an index fund. The question is it broad-based? No, it's just the price of palladium. You can't get much narrower if you tried. So, S&P 500 broad, yes. ETPMPD, no. Not broad at all. Very, very narrow. Where does the Nasdaq-100 actually fit on that scale from palladium up to the S&P 500? What is it more similar to? Here are the top stocks of the Nasdaq-100. Apple, Microsoft, Amazon. You can see for yourself the weightings. These tend to be tech stocks, not all of them, but the Nasdaq is certainly heavy on the tech. The question I'm going to ask is, are they actually similar to each other? If you buy into one company, is it just like replicated across the entire index, or are they quite diverse? Here is Apple. It does phones, watches, desktops, Apple TV, a range of services. Does Tesla do phones and watches? No, not to my knowledge. Nvidia, does it do phones? No, it's about graphics cards. All right, we're off to a good start. Microsoft does Windows, Office 365, it does Teams. Does it make electric vehicles? No, it certainly does not. Does it make graphics cards? No, it doesn't do that either. Does it make a soft drink like PepsiCo? No, it doesn't. All right, not bad. Amazon, of course, is in retail and it does AWS. Does Tesla have a cloud services business? No, it doesn't. Well, that's a good thing. Tesla, of course, produces electric vehicles, so it quite stands out. Does it have an ad service network like Amazon and Google? No, not to my knowledge. Nvidia does graphics cards? None, to my knowledge, of the other platforms do. PepsiCo makes Pepsi drink, Gatorade, Frito-Lay, which is chips or crisps, and Quaker Oats. Does Tesla make Quaker Oats? No. Does Alphabet make food? No, it certainly doesn't. As far as being broad-based, I consider Nasdaq-100 to be semi. It's definitely not single like straight palladium, but it's not quite as broad as the S&P 500. So, semi it is. The next requirement for an index fund, the whole purpose of investing in, say, the S&P 500 is because of its high growth. S&P 500 does have high growth, we'll give that an automatic pass, but what about the Nasdaq? Here is a graph which compares the entire lifetime, literally, of the Nasdaq-100 to the S&P 500. In pink is the S&P 500, which trails along down the bottom, 2,000% over that time period. In blue, that is the Nasdaq-100, which goes 10,000% over the entire lifetime that the Nasdaq-100 has been in existence, 2,000% for the S&P 500, 5 times the return for Nasdaq. This is incredible. If I told you there was an index that could beat the S&P 500 by 5% consistently over time, would that be worth going for? Yes, it certainly would be. Extra 5%, I mean, that's incredibly up. That's like 50% increase. But no, this is 5 times. That's how ridiculously powerful the Nasdaq-100's growth has been over its entire lifetime. So, very high return, the S&P 500, yes. Nasdaq-100, extra yes, just because it's so amazing. Positive expectation means we expect the general trend to be upwards and market dips to always be outgrown. The amazing thing about index funds in general, particularly things like the S&P 500, perhaps not so much Palladium, is that you can put your money in there any time, whether it's dipped or whether it's at its peak, knowing that over time there is a positive expectation of the index and the market growing and growing and growing, and it will outgrow any problems. So if the market crashes today, you don't have to worry about it because it will eventually outgrow it. Positive expectation. Here is the S&P 500. Yeah, that's positive expectation. Have a look at the crash of 2008, 2009. That is a global financial crisis. You can certainly see a bit of a dip, but as you pull back, it's outgrown that dip so much. That is the powerful of positive expectation. Around about 2020, the virus who shall not be named, bit of a dip there, but positive expectation means it's outgrown that. And more recently, definitely a drop in the market, but positive expectation will predict that will outgrow this dip as well. So you got nothing to worry about. Here is the Nasdaq in blue. Around about 2000, what happened? It's a tech crash. You recall the .NET bubble. And yeah, I can see a bubble there. I can see a crash immediately afterwards, around about 2002. But positive expectation means if you hold it for a bit, it outgrows and there you go. You hardly even notice that little dip at all over the long term. More recently, of course, the Nasdaq has been down. And positive expectation over the entire lifetime would predict to me that it will recover from that and there'll be no problems at all over the long term. So, positive expectation on both the S&P 500 and Nasdaq, yes, yes. The next requirement I have for an index fund is it outperforms actively managed funds in general. Warren Buffett did a little bet with hedge funds to say whether the S&P 500 would outperform their hedge funds. Buffett ultimately successful contention was that, including fees, costs and expenses, an S&P 500 index fund would outperform a hand-picked portfolio of hedge funds over 10 years, and he did win the bet. So the S&P 500 outperforms, on average, actively managed funds. Yes, we've demonstrated that. The Nasdaq outperforms the S&P, so extra yes, it outperforms actively managed funds. Only suited to investors who can accept volatility. This is really important because it's one thing if your index outperforms, but you have to be prepared to take the bad with the good. The bad, of course, is the drops, and they can be dropped for years at a time. Of course, positive expectation takes over, and we're not worried in the long run, but is your mind, is your temperament suited to that volatility? If it's not, perhaps you shouldn't be in shares at all. But let's have a look. Here is the S&P 500 between the dates of 2006 and 2010. That's a 4-year period. You'll notice it's going along, then has a great big dip, and it starts to recover, but not as much as it dipped. That is 4 years, and you basically went backwards over that period. So the S&P 500, is it volatile? Yes, it is. Is the Nasdaq-100 volatile? Yes, they're both volatile. Risk versus reward. This is volatility, as in going up and down. I mean, it's a type of risk, but it's not a risk over the long term that you will lose money. But over the short term, if you need to cash out all your money right now, yes, it's certainly a risk. And it's a risk you have to be expecting to take. That is the S&P 500 versus the Nasdaq. Can we summarize it to a face-off? So in summary, index fund, yes, across both. Broad index fund, yes on the S&P. I'm going to give that orange, so half on the Nasdaq. High returns, well the S&P 500 does have high returns. In comparison to the Nasdaq, not so much. So I'm giving the S&P 500 orange. Positive expectation, yes on both. Outperforms actively managed funds, yes on both. Volatile, yes on both. The oranges should give you a bit of a clue as to what is going on. With Nasdaq, you are trading broadness for a higher return. That's exactly what you're doing there. Does narrowing down stocks always lead to a higher return? No, it doesn't. All we can say for sure is that in the case of the Nasdaq, yes, it does. This is great. We have the raw data. How can we interpret this? What type of investor should be investing in the Nasdaq, which outperforms, and what type of investor perhaps shouldn't be? Here is Gary Growth. Hello, Gary. Gary wants to maximize his returns. He's tolerant of market fluctuations, and he's investing for the long term. All good attributes, Gary. Gary Growth's possible portfolio choice is 100% Nasdaq-100. Why not? He wants growth. That's the thing he's most after. He's quite comfortable with fluctuation, so he would be an excellent candidate to forego the S&P 500 and go 100% into Nasdaq because over the long term, it's proven it's outperformed. Here is Mixed Merrill. I don't know where Merrill is going with those clothes and that hair, but we're here to discuss her investment options. Mixed Merrill wants to have maximized returns, but she's scared of market fluctuations. Merrill, I think you've got a problem there. You want something that you can't really have, which is maximum returns. Oh, but I don't want volatility. Too bad. You can't have both. But she is investing for the long term, so that's a good thing. The possible portfolio for Merrill is, say, 60% Nasdaq, 40% bonds that will smooth things out, or you can go for 60% S&P 500 and say 40% bonds. The bond to stock ratio doesn't really matter. This is just an example. This could be an example of where you might want to pull back to the S&P 500 if you're a little bit more cautious. Remember, Merrill does not like so much fluctuations, which is why we shoved in the bonds. Arguably, you could just stick with Nasdaq, stick with the bonds that would smooth them over there. So I'd say you've got both choices, Merrill. Here is worried Wendy. Hello, Wendy. Wendy is scared of market fluctuations. She wants stability and she's investing for the next 10 years only because she's getting on in life. Worry Wendy's possible portfolio options are something like 50% cash and 50% bonds, so we've actually dipped out of the market altogether. So this is interesting. When we're pulling back from the share market because, we don't like volatility, then you're actually pulling back for the Nasdaq and the S&P 500, so it doesn't really matter. Only people who are comfortable with the share market in general should be in it. And therefore, the choice comes, should you be in the Nasdaq rather than the S&P? And often the answer is yes. So, we have concluded that the Nasdaq-100 outperforms the S&P 500. That has been proven in a previous video, but a lot more in depth. Most cases where the S&P 500 is a suitable option, the Nasdaq may also be a better choice, which is what this video is about. Ultimately, it is a personal decision for you. You know the data and which index performs best, but you may have some parts of your mind that determines that one of these indexes is better than the other for you personally. We found that by narrowing down to the Nasdaq from the broader S&P 500, we actually made gains. It performed better. But the question is, if we go the other way, what happens? So, is there an ETF that takes in the whole world? The answer is yes, there is, and we'll discuss that in the next video. Make sure you subscribe so you don't miss out. How would the performance of the entire world, what does that mean, by the way? The entire world is the top stocks right across all the markets. It'll still be market cap weighted, so it's like the S&P 500, except we look at all exchanges. And how will it outperform or underperform the S&P 500? That will be revealed in that video. In this video, I asserted that the Nasdaq-100 outperformed the S&P 500. Easy to assert because I showed you the graph. The question is, what's happening now? Because that's over the long period of time. In the last few years, is that still true, or has the Nasdaq fallen away to a point where perhaps over the entire history, yes, it outperforms, but more recently there's been a tech wreck that means that you should now give up the Nasdaq and focus solely on the S&P 500. To make that determination, I would need to see more data. I would need to see graphs over recent periods of times as well, but I've done the video on that showing you all that data. Go ahead and click on it here.